keep moving. So we'll talk about some financial statements. For financial statements. So where are we reporting all this information? We're reporting it on financial statements. The four main financial statements are your income statement, which is just your revenue minus your expenses. We have retained earnings. That's going to be your income. Income is revenue minus expenses. And then that income gets put onto your statement of retained earnings along with any dividends. And then that information, your retained earnings, goes onto your balance sheet as part of your equity. And then we have a statement of cash flows that reconciles all of this based on how our cash inflows and outflows of a business. So because we use GAAP accounting, which is also known as accrual-based accounting, ACCRUAL, accrual-based accounting, that because we used accrual-based accounting, we also want to know cash inflows and outflows. We might receive and recognize revenue based on credit, but we didn't receive any cash. So on the statement of cash flow, we wouldn't show that revenue was recognized. It's going to be separate statements. And so that's what it looks like here. And that's what I was showing you with Apple earlier. So if we go to Apple, it has all of these statements. Apple has balance sheet, we talked about. They start with their income statement. What's their income statement? They have, or they also known as a statement of operations. They have their sales. How do they make their sales? Through products and services. They have a cost of sales, which gives sales minus cost of sales as our gross margin. And then our gross margin, less operating expenses. We'll go into all these formulas and details. Give us our net income. That net income, won't worry, this is another advanced statement, don't worry about it. That net income will go into our statement of shareholders' equity. And that statement of shareholders' equity gives us our shareholders' equity at the bottom, which ultimately goes into our balance sheet. Our balance sheet is just our accounting equation. Assets equal liabilities and equity. And then our assets, total liabilities and equity, always equal our assets. 354, 354. That's Apple. Now we look a lot more simplified here. For this business we just did, we have our income statement where we calculate our net income. Really important here, revenue is different than income, right? Revenue is how much we've earned. Income is revenue minus expenses. Memorize these formulas. So when you hear someone say, hey, I made a lot of money with my business, I made $1 million in revenue. You might say, well, that company's doing well. But if you know accounting, you say, well, what was your income? They say, oh man, I actually had a loss. I had lost $500,000. Okay, is that a good business? No. Now, potentially it might be, maybe they have growth, but that's the way we need to think, right? You can make something sound good when it isn't good. Then we take that income and we make a statement of retained earnings. So our net income less dividends equals our retained earnings. Memorize this formula. Net income minus dividends is our retained earnings. That retained earnings is used on the balance sheet as part of our equity account. So assets always equal liabilities plus equity, right? Assets equal liabilities plus equity. Memorize that. Our assets will equal part of the equity that is equal equity, which includes retained earnings. So we have to prepare these financial statements in a specific order, right? We can't know what our total equity balance is until we've done the statement of retained earnings. Because we can't know the statement of retained earnings until we've done our income statement. So this is the order. We always follow the order. Income statement, statement of retained earnings, balance sheet, and then finally we do our statement of cash flow. Our statement of cash flow uses the cash balances to determine how they were made. The cash flow breaks it out into 3 types of activities. Operating activities, what we do for our business, investing, any long-term assets we purchased, and financing, how we got our cash, either through shares or through financing or through loans. There's a lot here, and we're going to spend a lot of time going in this detail. All you need to know right now, all I want you to leave this with is 4 financial statements: income statement, statement of retained earnings, balance sheet, and statement of cash flows, and their order. How do you prepare them? Income statement is first, statement of retained earnings second, balance sheet is third, statement of cash flows is fourth. And that's what all I need you to know for this slide, and then make sure you start reading into this and learning it. How do you determine income? Revenue minus expenses. How do you What is the balance sheet? It's just the accounting equation. Assets equal liabilities plus equity. I'm repeating this because this is the important information. And so here's another need to know example. I want you to work through it yourself. I have all the answers here. Okay. If you want to stay after class and go through one of these examples, well, if we finish early, we can. But I want to make sure we're all adults here. You can work through it, and then I'll leave 10 or 15 minutes open to the next class where we can go through examples as well if we're struggling on something. So this is sustainability. This is what I talked about, how like we can't measure environmental or social governance really in dollars. And so there's some nonprofit organizations trying to figure out ways to do this measurement. So this is a Sustainability Accounting Standards Board talking about how do we value green initiatives. It's still very new, and there's other tools that people are using in order to determine this kind of overall benefit to society. Called like similar to something called like the balance scorecard. There's all these different metrics you can use. Just know they exist. I don't need a lot of detail. That's not what the class is focused on. But it's interesting. It's interesting. How do you value in societal growth or societal benefit? Okay. Next piece, return on assets. Whenever you see a formula like this, you just need to memorize it. It's going to be the rest of your education. Your return on assets, you're going to be asked this question in your managerial accounting class. You're going to be asked it. If you go down to your any business class, you're going to learn it in your finance class, your advanced accounting courses, your marketing courses. Just memorize the formula. Just do yourself a service, memorize it now. What is this telling us? How much dollars have I invested in a company or invested in assets? And then how much money am I making off of those? You hear a lot of this with your ROA or ROI or your ROA if you own real estate, right? Like, hey, at home in the Bay Area might only give you a 3% ROA because you can only rent it out for so much. But in Minnesota, it maybe is a 10 or 15% because you can make more income, right? Income is revenue minus expenses, make more income based off of your average purchased assets. This is a way. Why do we make these metrics? It's so we can compare companies. This is the comparability we talked about. So both Verizon and the industry are using GAAP metrics. So they're calculating net income and total assets in the same methodology. So we can compare their return on assets and determine Verizon is outperforming the industry based off that. You can compare company A and company B and determine if one is a better investment if you want to become a portfolio manager. This is another high-level topic. You can I can give a whole class based on return and risk analysis, but there's many different ways we can report returns. We talked about return on assets. You can also talk about return on investment. You can talk about interest returns or returns on corporate bonds. And your question is, anytime you make an investment, your question should be, how risky is this? And what's my expected return? The risk should match your return, or you shouldn't make the investment. If I'm entering a riskier business, I should expect a higher return. And you should be able to quantify it. You should be able to put a number to it. If you can't, don't enter the business. You don't know enough yet. So this is using an example. How do we measure risk? And this is, I really care about this because I want you all not to make mistakes that I've made. I'm going to talk a little bit personally about like when I was a musician. I did a bunch of shows in Los Angeles, and I opened my own recording studio. And I sold, from all the work I did when I was young, I opened a recording studio. It cost me maybe $50,000. All the money I've been working since I was 15, all the money I saved, I bought a recording studio in North Hollywood. And I thought it was awesome. I had musicians coming in all the time. I was making my own albums, but I didn't do an assessment. I didn't do this kind of assessment of, hey, what's the risk for this? And then what's my return? And so after I found out like to rent the space, to buy all of the mixing boards, to buy all the microphones, I could charge maybe $50 an hour to rent out my studio. And then at the end of it, I found out that even though I was making $30,000, $40,000 a year in my recording studio, I wasn't getting a strong return on my assets. I was getting maybe from my revenue and expenses, I was maybe getting a 5 or 10% return. That's fine. I can invest in the market and get the same return. but I still have to pay myself an hourly wage. And so after I paid myself minimum wage, I had almost no return on assets. I could have invested in a treasury stock and made more money. And so even though it was something I was passionate about, if I knew this before I started my business, I could have said, hey, wait a second, I just invested $50,000 to pay myself minimum wage, right? And I want you to all to be careful if you're thinking about driving Uber, or if you're thinking of doing Uber Eats, or if you're thinking about college, if you're thinking about going after this to an expensive college or a cheap college, thinking about degrees, thinking about if you want to get a liberal arts degree, if you want to get an accounting degree, a marketing degree, do an ROA. You have the tools now. Make sure that you know if the money you're investing is going to give you a better return than what you could be doing now. So just do quick math. Be like, hey, if I can make $100,000 a year in 5 years and I invest $10,000 a year now, is that a good return? Yeah, that's a pretty solid return. But hey, if I spend money buying a car and I only make $20 an hour, hey, is that a good return? Maybe not. So try to think of your decisions through that lens. If I could go back, I would have just gotten a college degree sooner. So even though it was a fun and interesting, good learning experience, but that's what I want you to think of, right? You can have alternatives, you have choices. And so a way that we measure risk is we benchmark it against the treasury bond or treasury rates. Right now they're like at 1%, they're very, very low. And then as we move up the risks, we expect greater returns. Do those returns give us, are they consistent returns? No, as we take bigger risks, there might be downs, there might be ups. These are returns we'd expect for being willing to take those risks. A good return is about 10%. 8 to 10% means we're in a strong return territory. Why is that boring to people? It's boring because no one wants to know that the way you get rich is by hard work and a lot of time. But that's the truth of the matter. 90% of millionaires became millionaires through hard work and through careers and through saving over a long period of time. You don't gamble your money away. Don't try to make big hotshot investments. Try to find a good 8 to 10% return on your business and find a good paying job and make smart investment decisions. That's how I can guarantee every one of you could become millionaires if you follow that advice. So really look at that and think about every decision of, hey, should I do this? Is this risky? If it's risky, am I going to get rewarded for it? If it is it not risky? Am I still going to get rewarded for it? Can I benchmark? Can I make other decisions that are going to give me a return? That's how businesses think too. Next, business activities and the accounting equation. This was on the statement of cash flows. And so I want us you're going to have to learn this. And so just start thinking about it now. But we have 3 different ways that 3 things really businesses do, right? We operate, we get money through those operations. We can get money through financing, or we can get money through investing. So what is financing, investing, and operating? A financing activity is when an owner gives money to the company or when we borrow money. That's a financing activity. So anything related to a liability or equity is a financing activity. Long-term equity or long-term liability or equity. Anything related to a long-term asset is investing. Hey, if we're going to buy a really big asset, if we're going to buy a building, that's an investing activity. If we're going to sell a building, if we're going to sell a large piece of equipment, that's an investing activity. And then operating activities are related to short-term assets and short-term liabilities. I have a whole lecture on cash flows that you can go on YouTube and we'll do it later. But I just want you to think about this, that we have our day-to-day operations that we can do as a business. The day-to-day operations are short-term assets, short-term liabilities. Like, hey, I can borrow some money real quick to buy some supplies. That's an operating activity. Or I have investing activities. I can buy a building that hopefully makes me a bunch of money. I can rent it out or work out of it. Or financing. Like, hey, I can borrow money or I can give money. I can borrow money or I can give money to my business. Or I can give dividends, give it back to my owners. So that's the thought. That's really what businesses do. And you can specialize in any of this. Hey, do I want to become an operational expert? Do I want to get really good at investing and managing assets? Or do I want to become a banker and really understand the financing aspect of businesses? That's how the statement of cash flows is structured. And so that's the thought here is kind of this whole cycle, right? We operate, and what funds these operations is either the operations and investing activities and financing activities. And all throughout it, we need people planning to make sure that we're optimizing the strategy. So that's a lot. I breezed through it because I'm going to give you all the recordings so you can go back to it. I want you to work through all those in-class quizzes. And I want you to make sure you see, before we log off, I'm going to have an open Q&A. I'm going to make sure you see here, and I'll share these with you. I've made really custom videos on, let me see. On this playlist that I shared with the class in an announcement. I can share these specific videos. Oh, not managerial accounting. Let's see, accounting basics. On the accounting equation, I want you all to watch this one. And I want you all to watch the debits and credits and accounting principles. Oh, there we go.